Securing a property at auction can be a great move, but is it a smart one? Have you carried out your due diligence in regards to value against price? Have you factored in the cost of financing? And have you considered your exit strategy? I'm going to break down how to protect yourself, but most importantly, your money to ensure you make a profit. We'll cover modern day auctions and traditional auctions, how to calculate the GDV, which is the gross development value. So that's the value of the project at the end of the works being completed, how to calculate the cost of financing in minutes, and finally, how to exit the financing effectively so that you can repeat the process and build long-term wealth. Now, if you're new to my channel, hi, I'm Jonathan. I started SPV Mortgages around 6 years ago. Over that period of time, we've helped hundreds of property investors start and build successful property businesses. My channel is all about the experiences I have working with them, sharing those experiences with you. So there are two types of auctions. There's a modern day auction and a traditional auction. With a modern day auction, you exchange on the day or close to it, but the completion date is pushed out to around 56 days and sometimes more. With traditional auctions, you exchange on the day and complete within 28 days. It's important to understand the terms and conditions of the auction before you enter into it. If it's a traditional auction where you need to complete within 28 days, the only product that I would recommend would be bridging finance, and it's simply because bridging finance can be turned around in as little as 3 to 4 days, which means that you're guaranteed to be able to complete within the time frame without any penalties. Now, with a modern day auction, you can use a traditional SPV buy-to-let mortgage. However, you only get one chance at the application, so you've got to proceed with a bit of caution on that. Now, if it's a traditional auction where you've got to complete within 28 days and the only product is bridging finance is one of the most expensive products available on the market. Now, the cost of the bridging finance needs to be baked into your numbers, and that's what we're moving on to next. The value of the property can be very difficult to obtain, but there are certain ways to protect yourself and bake in a profit margin between the price paid and the actual value of the property. Now, sites like Rightmove, Zoopla, Land Registry offer such data sets, but just be mindful that some of those data sets can be a little bit out of date. Speaking to estate agents is a very sensible idea, because not only can you establish what the price range of the property will be once you've carried out works, renovations, modernisation to it, but also you'll be able to understand the demographics in the area that the property is located. For example, I would want to know if the property that I just bought should be targeted to first-time buyers, home movers, landlords, or a combination of all three. That will then set you up in regards to knowing which type of buyer the property can be sold to. Now, if you're looking to retain the property as a long-term investment, I would be speaking to estate agents and obtaining rental figures from the property that you're looking to purchase. That will then dictate what the exit strategy would be, which is so important when buying at auction, but also it will give you a bit of an indication of the net returns that the property will generate if it's kept on a long-term basis and not flipped. So lastly, you can obtain a report from HomeTrack. So that's a valuation report, costs about 20 quid. What's interesting about HomeTrack, and in my opinion, I think HomeTrack has by far the most accurate property data sets across the whole of the UK. And the reason being is large lenders, such like the Santanders and the Nationwide and NatWests, they use HomeTrack for their valuation data. So when you purchase a property, which is a residential property, the surveyor will go out, instructed by obviously the lender. They'll carry out the valuation. The valuation report is sent back to the lender. It's also sent back to HomeTrack. So every single day, HomeTrack is receiving hundreds, if not thousands, of RICS qualified surveyor reports. So once you have a good idea on price, you can then work backwards from that to create what I call a ceiling price. So that is where the bid cannot exceed on the day of auction. It's the price point that eats too much into the margins, and at that point, you're just going to walk away. So most investors buy at auction to add value to property. So in other words, they're undertaking property projects. And the idea is that they build up to bigger and bigger projects to increase their profit margins. But the sole reason for buying at auction is to buy something which is run down, something that you can modernize, maybe refurb, maybe carry out an extension, to add significant value to, so that you can extract that value and repeat the process. I call it a recycling strategy. So here's our bridging loan calculator that I've designed on the SPV Mortgage website. You can use that to your heart's content. It's free of charge. You don't need to log in. The very first thing I'm going to select is the transaction type. So this is a residential purchase. I don't have any additional securities to add, but I do understand what the purchase price is, which is £500,000. I've got a deposit of 35%. which gives me a net loan of 325,000. Now I want to input the actual bridging terms. So I want a term of 12 months to provide me with enough time on the product for me to carry out the project and exit the loan. Really important. I'm going to pop in a bridging loan rate of around 0.9%, but I think I can exit the loan in around month 7. So that gives me a net loan of 325 grand, product fee of around 2%, monthly interest £3,305, a total interest over 7 months, 23,140, giving me a gross loan of £355,486. So that will be the amount of money that I owe to the bridging lender after 7 months. Now the calculator automatically calculates the cost of stamp duty. I'm going to pop in legal fees of 2.5 grand and a valuation fee of 2,250, meaning that my total acquisition cost, so this is the total amount of money that I would need in order to move forwards with this project, is £218,250. Now, I know following completion of the works that the gross development value, so the end value of the project, is going to be £850,000. The cost of the works is going to be £150,000, meaning that acquisition costs £218,250, so that's the physical amount of money that I need to put into the project. The bridging loan debt will be £355,486. Cost of works 150 grand. So the total costs for me to complete this project, including everything, is £723,736, leaving me with a profit of £117,763, which isn't too bad. Now, if I scroll down to the bottom of the calculator, it breaks down 2 different exits for me. So I can look at flipping, which is sale exit, and I can also look at a retain and hold, which is a refinance exit. So if we look at the sale exit, I'm going to sell the property for 850 minus the sale cost, which is around 1%, less the bridging loan debt. Net proceeds on completion will be £486,013, less the cost of works, because I had to fund that, less the acquisition cost, I'm left with a profit of £117,763. Now, if I wanted to retain the property as a long-term hold, I would want to know at the end of the project how much equity I could pull out in order to recycle that equity into the next project. So if I look at a 75% mortgage, and I'll pop in an interest rate of 5.5%, it means that after repaying the bridging loan of £355,486, I can actually pull out £282,013. That is the amount of cash that will be provided to you on completion of the refinance. Now, what the calculator will also do is calculate the monthly interest charges, so then you can work backwards in regards to the rental income just to make sure there's enough margin there in order for this to be a suitable refinance project. Now, the monthly payment, £2,929. So if I'm in receipt of a rental income, or if the estimated rental income is a lot higher than £2,921, then a refinance exit is definitely the path that I would choose. Okay, let's look at a slightly different transaction type. So let's just say that I'm at auction, I found a property for £1 million, but I'm asset rich, cash poor. So once again, type of transaction, residential purchase. I'm going to put in a background property now. So let's just say that I own a buy-to-let, which is sitting in the background. It's worth £500,000 and it has a mortgage of 150 grand on it. What that means, and what the calculator's just calculated, is that I can utilize 196,000 approximately worth of equity in order to fund the new purchase. Now, if I pop in purchase price of 1 million, deposit of 20%, which gives me a net loan of 800,000. Term once again of 12 months, because I want enough time on the product to make sure that it doesn't expire and I don't get hit with any penalties for not paying early. I've got a rate of 0.8%, and let's just say that we're going to exit the loan in month 8. So combining both properties into the same deal gives me a net loan of £976,800, meaning that the deposit requirements only £23,200 to buy £1 million property at auction. Now let's just say that the legal fees are £2,500, the valuation fee is say £3,000. It basically means that I would need £120,950, and the majority of that is pretty much coming from the stamp duty, in order to move forwards with this purchase at auction. Let's just say that the gross development value, once I've completed the build, is 1.75 million, and the cost of works is £250,000. That would give me a net profit of £305,626 once the works have been completed. Now, if I was to sell the property, obviously that's £305,000 in my back pocket on completion. If I was to refinance the property at 75%, and let's just say this is an HMO property that you're looking at, we look at an interest rate of around 6%, that would be £6,562 per month, but I could pull out nearly £250,000 for me to then invest in the next project. Exiting the loan. So this is a critical part of your process if you're thinking to buy at auction, regardless if you're looking to flip or retain. More often than not, I see new investors who get into the auction space neglecting the rental side of the calculations. And what I mean by that is they're so fixated on price and GDV, they forget about the rent that the property will generate once the project has been completed. And that's super important, whether you're looking to flip or whether you're looking to retain, simply because it's the rental income which dictates how much you can borrow if you're looking to refinance the property. Now, with certain projects, there is enough profit margin built in to the project following completion of the works that will allow investors to retain properties as long-term assets, but also release the capital in order for them to recycle that into the next project moving forwards. When you're looking and when you're pricing auction properties, it is absolutely essential for you to carry out that rental assessment with estate agents. Now, if you're looking to flip the property, then you might be happy with, for example, a 12 to 18% profit margin, which a lot of developers are now working on these days, given the cost of materials and the cost of labor. But if you're looking to retain the property, then effectively what you want is a lender that will work on what's called open market value. Now, open market value is the value of the property based on the day that the surveyor visits. For example, if you bought a property for £1 million today, you've added some value, but the value of that property, because of the works, because of the value add, is now 2 million. You want the valuation at 2 million to extract all of that value moving forwards. Now, the good news is, currently, there are 3 lenders in the SPV space that will lend on the open market value within 6 months, which then means if you're looking to do a property project, buying from auction, adding works, and then refinancing, holding the asset, taking the equity, and recycling that into further projects, you can do all of that within 6 months. Now, if you're thinking about carrying out a property project and you're right at the beginning stages, so you want to understand a little bit more about bridging finance, how it works, what the risks, and how you might be eligible for a bridging loan, watch this video.